Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the real money, and give you the clarity you need to trade with confidence. If this is your first time here, hit that subscribe button right now because this is exactly the kind of deep dive analysis we bring you every single day. And today, we are tearing into one of the most explosive and dangerous stocks in the entire market right now, AMC Entertainment. Is this a genuine fundamental turnaround finally arriving after years of pain? Or is it a brilliantly disguised bull trap designed to crush retail traders the moment they pile in? We are going to break down the exact options data, the hidden institutional money flows, and lay out a precise trade blueprint you can act on immediately. But before we get into any of that, let me paint you a picture of just how wild this situation truly is, because the price action alone tells a story that most people are completely missing. On June 1st, AMC went absolutely parabolic. We are talking about an aggressive surge up to an intraday high of $2.21, a single-day launch of 22%. Now, if you were watching that day, it felt electric. Social media lit up, retail traders rushed in, and the momentum was undeniable. But here is the thing. If you blinked, you missed it. By June 8th, the stock had pulled back and was consolidating around $1.79. That explosive candle printed, and then gravity immediately took over. So what does that actually tell us? This was not random market noise. This was a direct, violent collision between two massive opposing forces, a record-breaking box office recovery slamming head-on into a severely leveraged balance sheet. And that collision, that exact tension, is what makes AMC one of the most dangerous and most exciting setups in the entire market right now. Now, here is a question worth sitting with for a moment. What are the actual odds that a company carrying this much structural debt can sustain a genuine multi-month rally without something breaking underneath? It is a slim chance. But we are going to follow the data and let the charts and the money flows tell us the real story. Let us start with the bull case because it is genuinely compelling and rooted in hard, undeniable numbers. In May, AMC welcomed 25.5 million global guests through their doors. That is their highest May attendance since 2019, before the pandemic wiped out the entire industry. Think about that for a second. Over Memorial Day weekend alone, 4.2 million people flooded into AMC theaters. That is a cultural statement. People are not done going to the movies. And the film slate driving this foot traffic? It is loaded. Backrooms pulled an $81 million opening weekend. The Devil Wears Prada sequel is generating enormous buzz. The Mandalorian and Grogu is packing seats across demographics. And then there is Christopher Nolan's The Odyssey. Advanced ticket sales were so overwhelming, they literally crashed the AMC app. Let me put that in context for you. Crashing a major company's app from pure ticket demand is Taylor Swift Eras Tour territory. That is a level of consumer urgency that cannot be manufactured. CEO Aron is also throwing his weight behind the Paramount and Warner Brothers merger, which has secured a massive 30-film pipeline and, critically, locked in a strict 45-day theatrical exclusivity window. That exclusivity window is a lifeline for theaters. It forces studios to let films breathe in cinemas before streaming platforms can touch them. And on social platforms like StockTwits, retail sentiment has turned extremely bullish, with serious chatter building around the potential for another severe short squeeze. The conditions for a momentum explosion are absolutely there. So far, so good, right? Now let us peel back the curtain and look at the financial reality, because this is where the story gets complicated, and this is the part that most retail investors either do not know or choose to ignore. AMC delivered $1.045 billion in first-quarter revenue, a genuine beat against Wall Street expectations. They also posted $91.3 million in adjusted EBITDA, their strongest first-quarter performance since 2019. On the surface, these numbers look fantastic. Revenue is growing, attendance is recovering, the top line is finally moving. But here is the burn hidden beneath the beat. Despite that billion-dollar revenue, AMC still posted a net loss of $117.1 million. And here is the number that should stop every long-term investor cold. Their free cash flow for the quarter was negative $174.7 million. Free cash flow is the actual lifeblood of any business. It is the money left over after you pay all your bills to operate and grow. When that number is deeply negative, $174 million negative, it means the company is spending more to keep the lights on than it is pulling in. They are making more revenue than they have in years, and they are still bleeding cash. That is not a recovery story yet. That is a company fighting for survival while putting up impressive surface numbers. And that cash burn leads us directly to the most dangerous word in the retail investing dictionary right now: dilution. AMC is currently carrying approximately $9.6 billion in total liabilities. Buried inside that figure is an estimated $7.3 billion to $7.9 billion in long-term debt. When you are burning $174 million per quarter in cash and carrying that kind of debt load, you have one move available to you. You issue new shares to raise capital. AMC recently raised $7 million through at-the-market equity sales, and every single time they do that, they carve the ownership pie into thinner and thinner slices. The shares you hold become worth less. Not worthless necessarily, but less. That is a slow but constant headwind every AMC shareholder is fighting against. So we have two powerful, opposing forces: a genuinely impressive operational recovery on one side, and a suffocating mountain of debt with ongoing dilution risk on the other. This is the tug-of-war that is driving the extreme and unpredictable price volatility. The market simply cannot make up its mind whether AMC is a triumphant comeback story or a slow-motion financial collapse. And until the balance sheet tells a different story, this tug-of-war will continue. Now let us talk about where the smart money is actually going, because this is where things get genuinely fascinating. CEO Aron recently stepped up and bought 250,000 shares of his own company at an average price of $1.38. He deployed $345,000 of his own personal capital, increasing his stake by 11.43%. When a CEO is buying with their own money, not stock options, not restricted share grants, but actual cash, that is one of the most powerful signals of internal conviction that exists in the market. The market notices. Traders notice. On the institutional side, which currently holds roughly 28.8% of the float, we are seeing aggressive repositioning. Triumph Capital Management exploded their position by 139%. The Royal Bank of Canada boosted theirs by over 90%. These are significant bets by institutional players who have done their homework. But it is not unanimous. The Vanguard Group quietly exited their entire position, a 100% reduction. One of the largest asset managers in the world walked away completely. So what we have is a genuinely fractured institutional picture. Some heavyweight money is betting big on recovery. Other heavyweight money is walking out the door. When institutions are this divided, it tells you one thing: this stock lives and dies by its catalysts. And if you think the institutions are divided, wait until you hear what Wall Street analysts are saying. Because the analyst consensus on AMC right now is one of the most extreme examples of disagreement I have seen all year. On the bearish side, Citigroup is maintaining a sell rating with a price target of $1.20. Roth Capital has slapped a neutral rating at $1.50, explicitly citing the severe debt leverage we just walked through. These analysts look at the balance sheet and they see a company that could still be heading toward painful equity destruction. But then flip to the other side. Benchmark recently upgraded AMC to a buy rating with a price target of $2.50, arguing that free cash flow is on the verge of a major recovery cycle. Wedbush goes even further, outperform rating with a $3 target. The average consensus range sits somewhere between $1.96 and $2.24. When professional analysts with access to the same data are this far apart in their conclusions, it means one thing: nobody genuinely knows what happens next. The stock is entirely catalyst-driven. News moves this thing. Data moves this thing. A single box office headline can shift the whole narrative overnight. Now let us dig into what the technical indicators are actually telling us right now, because none of this fundamental analysis matters if the chart is telling a completely different story. With the stock sitting around $1.79, here is what the technical dashboard looks like. The 14-day relative strength index is sitting at 44.41, drifting out of neutral and leaning slightly into sell territory. The MACD is flashing a short-term bearish crossover at negative 0.013, so the immediate near-term momentum is cooling off after that June 1st surge. The hot money has partially moved on. However, and this is critical, the moving averages are telling a much more hopeful structural story. The stock is trading below the 50-day moving average of $1.83.4. But it is holding immediate support right at the 5-day moving average of $1.77.7. Most importantly, AMC is still fiercely defending the 200-day moving average of $1.57.3. That 200-day line is the structural floor. If that level breaks, the foundation crumbles entirely, and there is nothing left to hold the stock up. When we zoom in to the key pivot levels, the battle lines become extremely precise. On the downside, primary support sits at $1.75.4, with a secondary safety net at $1.74.2. On the upside, resistance levels form a staircase: $1.77.9, then $1.79.2, and the critical breakout level at $1.80.4. Clearing that upper resistance level with heavy volume is the prerequisite for the next meaningful upside move. But here is the wildest part of this entire setup. Breaking that resistance requires overcoming a hidden fortress built in the options market, and this is arguably the most important data point we have today. There is a massive call wall sitting at the $2 strike price. 126,696 open contracts are stacked right there at $2. Market makers and short sellers will do everything in their power to defend that level. If the stock starts drifting toward $2, they will sell into the rally aggressively to suppress it. Because if the price breaks above $2, they are suddenly on the wrong side of an enormous number of contracts. Now consider this. What are the realistic odds that retail momentum alone can bulldoze through 126,000 open contracts of resistance? Slim, but not zero. Because on the downside, there is heavy put support anchored at $1.50. The stock is pinned in a corridor. And then there is the truly explosive variable. Implied volatility is screaming at 131.2%. That is an extreme reading. The options market is pricing in a massive, violent move in the near term. It just does not know which direction yet. Combine that with over 63 million shares currently short, approximately 10% of the float, and a dark pool off-exchange volume running at 28%, and what you have is a literal powder keg sitting in that consolidation zone, just waiting for a match. So, how should you actually position yourself given everything we just laid out? Let us break it down by time horizon, because your approach should be completely different depending on how you are playing this. If you are a short-term trader, your entire focus is on cracking that $2 call wall. If retail volume can push price above $2 and hold it, it forces market makers to hedge by buying the underlying stock. That triggers what is called a gamma squeeze, a cascading mechanical buying process that can shoot the price rapidly toward the $2.50 analyst target. Your catalysts to watch are daily attendance headlines, particularly around the Odyssey release, and any additional short squeeze momentum building on social platforms. If you are a long-term investor, you need to be completely clear-eyed about the risk profile here, AMC remains a highly speculative hold until management can demonstrate they are converting this blockbuster box office momentum into actual positive free cash flow and credible debt restructuring. Until that debt mountain shrinks, the dilution risk is a permanent headwind. You are not investing in a business recovery yet. You are speculating on the possibility of one. Now here is your precise, actionable trade blueprint for the week of June 8th through the 12th. This is a tactical mean reversion setup built around the support and resistance levels we have identified. Your entry zone is between $1.75 and $1.78. This leverages the S1 pivot point and the 5-day moving average as your structural foundation. This is where buyers have repeatedly stepped in, and it is where risk is most precisely defined. Your hard stop goes at $1.55. No exceptions. Why there? Because dropping below the 200-day moving average and through that $1.50 put wall completely invalidates the entire thesis. If AMC hits $1.55, you take the small loss, respect the stop, and walk away. Protecting capital is always the first priority. Your first target is exactly $2. Take partial profits there. Do not be greedy. That call wall is a genuine ceiling, and it will hit like a concrete barrier. If price breaks cleanly above $2 on high volume, your second target extends to the $2.21 intraday high and stretches toward the $2.50 benchmark analyst price target. For options traders, that 131% implied volatility is not just a warning signal, it is an opportunity. Selling premium in this environment is highly lucrative. An iron condor, or selling cash secured puts at the $1.50 strike, is a sophisticated way to capture enormous premium while relying on that structural support level to defend your position. The volatility is pricing in a massive move. If the stock stays range-bound, the premium decays in your favor every single day. Now, before we wrap up, Smart Stock Sam wants to be completely transparent with you, and that means delivering a financial disclaimer. Nothing you have heard in this video is personalized financial advice. I am not your financial advisor. AMC Entertainment is an extremely speculative, high-volatility asset. The analysis, trade setups, and price levels discussed here are purely educational and for informational purposes only. Past performance and technical patterns do not guarantee future results. Any trading or investing decision you make is solely your own responsibility. Always do your own research. Always manage your risk. Consult with a licensed financial professional before making any investment decisions, especially in highly speculative positions like this one. Trading stocks and options involves significant risk of loss, including the potential to lose more than your initial investment. So here is the final, unbiased conclusion that Smart Stock Sam wants to leave you with. Right now, AMC Entertainment operates strictly as a high-volatility, catalyst-driven trading vehicle, not a foundational, long-term investment. For traders, the mean reversion setup between $1.75 and $1.78 offers a genuinely asymmetric risk-to-reward ratio with precise, defined targets all the way up to $2.50. There is real money to be made here in the short term if you manage your risk. For the long-term bulls, the story is not over, but it is far from written. AMC's structural survival depends entirely on management's ability to translate this incredible, real, documented box office momentum into actual free cash flow and meaningful debt reduction. Until that happens, you trade the volatility, respect the risk, and never size in bigger than you can afford to lose. Now here is the question I want you to answer in the comments right now. Do you believe AMC can break through that $2 call wall this week and hold it? Or do you think the debt story ultimately kills any sustained rally before the year is out? Drop your take below. I read every single comment, and I want to hear where you stand. If this breakdown gave you real clarity and actionable insight, do me a favor and smash that like button. It genuinely helps this channel reach more traders and investors who need exactly this kind of analysis. And if you are not subscribed yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss a deep dive like this one. If this video added value to your trading week, consider sending a super thanks using YouTube's support feature right on this video. Every single contribution goes directly back into producing more high-quality, research-driven content for this community, and it means the world to this channel. And finally, if you are serious about leveling up your investing and trading game, I want to personally invite you to join the Smart Stock Sam exclusive membership community. Members get early access to trade setups, deeper analysis, and a community of like-minded traders who are all committed to making smarter, more informed decisions in the market. The link to join is right below this video. Come join us. Let us grow together. Until next time, stay sharp, manage your risk, and I will see you in the next one.